Welcome to the February edition of the Webcast for Peters McGregor. I'm your host, Nathan Bell. I'm the Head of Research. Joining me today is our Chief Investment Officer. What's your name, mate?
Wayne Peters. Good morning, everyone.
And so today we're going to talk about four stocks in a little bit of detail. But before we do that, we'll just have a look at the disclaimer. As always, we're all care and no responsibility. Just give that a few seconds before we take that as read. Okay, we'll move along. So the first slide there is our performance. We've had a good 6 months. Probably the more important numbers for us is definitely the 10 years where we're still well ahead. And I think the 3 and 5 years is where most long-term investors tend to focus. And the point we'll make quite strongly is that we're actually very happy with the absolute returns. What's been, I guess, interesting about the index over that period is it's been extremely strong, and it's been very heavily driven by the big tech stocks in the US. There's about $1.5 trillion in market value ascribed to Facebook, Netflix, Amazon and Google at the moment, which is just a huge amount of money. And those stocks, despite the large multiples they're trading on, continue to suck in money. And I think for us, the way we're going to really separate ourselves from the index over the next 5 years is we think the market generally is at best expensive, at worst it's overvalued, but we're very comfortable with the valuations in our portfolio and with some cash on the sidelines ready to put to work at any time. We feel as that index slows down eventually, and perhaps we're starting to see that now with interest rates going up and some liquidity from the central banks coming out of the market. That's how we're going to distinguish our returns over the next 5 years in a way that's been much harder in the last 5 years, even though our absolute returns are just fine. To show a slide of our portfolio there, our top holdings, the only major change since November when we last had a webcast is that we sold Bank of America. This was a long time holding for us. It was a business whose share price shrunk from about 17 in a short period of time down to $11 last February, when it looked like there was going to be problems in China and they were going to bring the whole kit and caboodle down. As we know now, they more stimulus into their economy, and America's actually picked up a little bit, and so it was actually a pretty decent year for returns on the stock market last year. Bank of America, we sold it basically on valuation grounds. There's nothing wrong with the bank. People are now expecting with the Trump presidency that we're going to have higher interest rates, more growth in the economy and less regulation in the banking sector, which are all good things for banks, and particularly Bank of America. It's also the most interest rate sensitive of the large banks, with a 1% parallel increase in the yield curve is worth about $20 billion, $4.5 billion in pre-tax profit, which is about 20% of Bank of America's current earnings. But at the current stock price, which is about 22 or 23, you really need interest rates to move further ahead than what most people are thinking at the moment, and that was our view. So we'd like to buy into that business again if we get the chance, but it has been sold. So we're going to look at four stocks in a little bit of detail. Twitter is the first one. Can this bird fly? This is quite a contrarian investment. It's a much easier sell to potential clients or any investor to sell Google or Facebook with the rapid growth in advertising there. And despite Twitter increasing its advertising revenue fourfold over the last 4 years, it's a business that is down about 30 or 40%, or probably a bit more now, than since it listed a couple of years ago. It's got a few fleas. But with that, I'll hand over to Wayne. Wayne, do you want to give us just a little bit of background behind the investment case?
Yes, Nathan. We like the valuation a lot on this particular business. For those that are interested in gleaning some background, I would highly recommend the book called Hatching Twitter. The main takeaway from reading that for me was that you had really terrible management decisions at a number of critical points through the development of this business as it went through startup to becoming listed and becoming a much more stable long-term business. And the business continued to flourish. So when you find a business that even with poor management does well, that's something that you know, as a long-term value investor, we focus very much on. I think it was Zuckerberg from Facebook that said it was like a clown car that fell into a gold mine. So we believe it's definitely a gold mine. The revenue growth has been quite extraordinary since they've started to monetize the site, and we think the potential for that to continue to grow strongly is very much in place. What is not in place and needs to be tackled, and management and the board have recognised this, and this is the expense line. Primarily the money that's spent on research and development, which is way ahead of what it's been, you know, visually or actively achieving on the site, and secondly the employee costs through stock option issuances. To put that in perspective, the stock option issuances were around 30% of their revenue 2 years ago. The last 12 months has come in at 25%, and they're targeting high single-digit numbers. We believe in even single high digits on revenue is way too high, and we believe there's a lot of scope for management to reduce it. One of the issues, I guess, is Dorsey, who's one of the founders, is still the CEO, and I guess, you know, it may take a change of management at some stage, which the board is committed to do if Dorsey doesn't execute on their plans for those costs to be really brought under control to a level that we expect. I would note that Gates commented recently about one of the biggest mistakes he made at Microsoft, and I think it's quite telling, and it's certainly the way we think about the option expense at Twitter, is that he said once the business got past the startup stage and became well established with a lot of value ascribed to its brand name, his big mistake was issuing the amount of stock options that he did, and we clearly think that's been one of Twitter's big mistakes recently. So it's heading in the right direction, just not fast enough for the market view, and our belief is that will get there. The other area that really we found encouraging with the last earnings call, even though the markets took the short-term numbers as a negative and marked the stock down, it gave us an opportunity to top up our position. The numbers that we looked to, though, were very positive. The daily active user growth remained strong, with impressions and duration both up double digits. And for us, that was a tremendous sign and encouraging that the steps that they're taking to improve the usage and remove the negatives on the site as very, very positive.
As value investors, we're always very careful about protecting our downsides. So something we look for in our investments is where with plan A we make a lot of money, but with plan B we don't lose too much. And there's a few things about Twitter that we think have a plan B if they don't manage to continue to increase its advertising dollars, but also cut those costs and get a really meaningful bottom line. And that is there's $1 billion or more sitting on the balance sheet, which gives the company a lot of flexibility in terms of the long-term decisions it makes to drive that revenue over time. And I mentioned earlier there's $1.5 trillion in market value currently ascribed to the big four tech companies or online retail companies in the US, and yet Twitter barely has a market value of 10 billion. It's only about 10% higher than that. So plan A is that this business makes a lot of money and then justifies a much higher share price. Or plan B, we think this business gets taken out because it's one of the very few global platforms left, and it's extremely popular. It doesn't have the growth in terms of people using it that it used to, but that's not really the point of Twitter. It's about how useful is it to the people that use it, and we think it's actually becoming more useful, and there's a lot of things that this business can do if management sets its sights on it to improve the actual way the platform or the website works and improve it for customers in a way that they haven't been able to in the last 5 or 10 years. So moving along to Wells Fargo, we thought we'd just briefly touch on Wells Fargo because it was in the news a lot late last year. You may have seen that the previous CEO, John Stumpf, fell on his sword. He left the business after it was found that a lot of staff were opening essentially fake accounts for people. The really frustrating thing about this, I think from management's point of view, was this really had no benefit, no financial benefit to the bank whatsoever. The only benefit was to the staff members who were opening these accounts, who managed to get their bonuses or at least get their regular pay and keep their jobs when they were meeting sales targets. The fact that it went on for 5 years, I think, is what really undid management. It was something that they were essentially aware of or had been highlighted and it hadn't been dealt with properly. But in terms of investing in the business, nothing for us really changed. In the slide there, we've got a few important numbers, and if you follow Bank of America just as one example, all up it's had to pay around $16 or $17 billion fine for its behaviour pre-GFC. Now it's a huge amount of money, but even then it's only still not 1 year's profit for Bank of America. Yet the fine on this occasion was only $185 million. So it's not to take away how important this is, but in terms of the financial impact on the business, it was meagre at best. So what we've seen then is the Chief Operating Officer, Timothy Sloan, has come in. Now he's said he's going to change or look at the sales bonuses and how the staff on the front line are remunerated. The question mark overhanging him is obviously he's been around the company for a long time, so he's just really the right guy to change the culture. So far he's saying all the right things, but we're only going to find out in time whether he actually does what he says what he intends to. But the bigger aspect from Wells Fargo is that it's really a case of, is this an undervalued business that is going to continue to grow over time? And we don't think this changes the bank's ability to sell more products to existing customers over time, which is really the bedrock of its strategy. Moving on to 21st Century Fox. This is a company that we bought about mid last year, and it's a company that I'm sure is well known to most Australians, run by the Murdoch family. And what gave us the opportunity was, even though the overall markets are quite expensive, this is a good example of how cheap companies can become. This is a business that is facing threats from the shift to entertainment online, advertising shifting to other players like a Facebook and Google. And so people are questioning also whether Fox's main TV channels are going to be part of the cable bundle, which is like our version of Foxtel in America, where people are paying over $100 a month. And when you've got Netflix for $10 or $11 a month, people are wondering whether they still have to pay so much. And so we got this great opportunity where, if you did the numbers, essentially the business was trading on 9 times earnings. Or another way to look at it was, we were getting what we think is a gem in its fast-growing Star India business, which is an Indian cable business with over 600 million subscribers, which is growing quickly, essentially getting that for free. Wayne, is there anything else you'd like to add on Fox?
Well, no, other than, Fox is primarily a content provider, and the attributes of the business, the balance sheet, the management, and the potential for its content is still very, very significant. As you highlight, Nathan, it was under a cloud with the potential for cord cutting, but what we've seen is their key products really lend themselves well to what we believe will become a pick and choose model, and the distribution stream will potentially change, but the demand for the content is clearly there. For example, their Fox News network, the ratings have come out just post the recent US election, and compared to the 2009 election, the ratings were up very, very significantly. For Fox, it was 107%, so basically double the viewership that it achieved back in 2009, whereas the other major channels saw major drops. CNN, for example, lost half its share in that period. So Fox is definitely providing the high demanded product in the US. Other aspects that we really like about the business, clearly with a market cap of just over 50 billion, a net cash position of 15 billion, which gives it a lot of optionality. It's looking to put some part of that together with the the remaining Sky acquisition that they don't already own. They own Hulu. Who knows what that value is? You know, we've got our own internal estimates of what that is likely to be. But again, along with Star, we fully felt that at the time of our purchase, we were getting both those assets for free. And a key characteristics of many of our portfolio holdings is embedded in this business too, where you have founder and management with a large slice of the business. And we think that's absolutely critical to have them very focused on making the correct operational decisions and, as importantly, the capital allocation decisions with the money once they've produced it. And that has clearly been highlighted by the way they've bought back the stock over the last 4 years, where they've repurchased over a quarter of the business at prices that we feel are demonstrably undervalued. So this business gets a lot of the ticks that we look for in a business that we want to earn for the long term, and with the optionality that it has in India, which has the best demographics of any large economy around the world, we think we'll do very, very well with this business.
I don't think people probably don't agree with us about how well positioned this company is. If we move to more skinny or cheaper bundles in the future with ESPN, it costs people, or they're paying $8 a month for ESPN. So even if you don't like sport, that's what you're paying. And for a bunch of the Fox TV stations and shows and whatnot, you're only paying about $1 a month. So it's not a big expense for the cable providers. So even in a skinny bundle world, we think this is a business that is very sustainable. And also we've seen that the affiliate fees, which are the fees that Fox channels get from the cable providers, have continued to increase, and the popularity that Wayne just described with the covering the recent election on Fox News is still a great revenue raiser for the business. So our final stock we're going to talk about is a company called NVR. It's a US home builder. Don't be alarmed. I know most people, when they think about home building, it's you're probably looking at an AV Jennings in Australia, for example, where one of the biggest assets on the balance sheet is capitalised interest, which is really just an expense. And we see a lot of these companies, when it comes to a downturn in the housing market, a lot of them actually go broke. And the reason they go broke is because they've got so much debt on the balance sheet, because they have to buy, or they don't have to, but they buy these huge land banks which they have to finance regardless of how many homes they're selling. So the real secret sauce for NVR is that instead of doing that, instead what it does is it puts down a 10% deposit on land that it potentially will develop in the future. So it can sit there and wait without having to have all this cash or capital tied up on the balance sheet. And the flip side of that is that not only has it remained extremely profitable, and I've just shown you a chart there of the period between 2006 to 2015 is basically NVR has admirable shareholder returns, and then basically it's a huge gap to anyone else. You can see Pulte Group there with actually huge losses. And during the GFC, NVR was the only home builder that made a profit. But what it has also done over time is, because its balance sheet, it doesn't have all this capital tied up in debt or in land, it's been able to buy back shares. And over the last 20 years, it's actually bought back 75% of its shares on issue. So it's just absolutely remarkable. But I think it also shows that when you've got an insider owner manager, someone with their own money on the line, and someone who's been doing the job for 2 decades, essentially, in Paul Seville, a name I recently forgot in a television interview, much to my regret. And you can just see how different the economics are in the business, how they're prepared to follow different strategies that a corporate CEO who may only be there for 4 or 5 years is interested in pursuing. You get these corporate CEOs, they're really just there for 4 or 5 years trying to get their bonuses as big as they can, and then they leave. And you can see the difference. A very conservative balance sheet, very well run, didn't get into any financial troubles during the GFC. The company's been battle tested, and again it's an example where we like Plan A, which I'm going to talk about in a moment, where we actually see more houses being built in America. But Plan B is, if the share price falls, then we expect the company to put more capital to work buying back shares over time, and either way it will increase value. I just want to talk about a couple of tailwinds blowing behind the industry. So this isn't specific to NVR. We really like NVR as a standalone business. We think it's exceptionally well run, but there are some tailwinds here that we think could be a trigger for higher earnings in the future. The first one is that the millennial cohort, or the millennial population coming through America at the moment, is the largest in US history. And we're now getting to a point where the median age is approaching 35. And you can imagine what happens at that age, or sort of those early 30s anyway, is that people generally start buying homes and having children and getting married. And we haven't really seen that since the GFC. One, because obviously the millennial population has been growing up, but also people just put those big life-changing decisions on hold. And so you can see in the chart there that the next 10 years is looking very fruitful, provided that people actually do go out and buy new homes. There's also another trigger point here for building, and that is that US existing houses for sale as a percent of the US population is basically at a record low at the moment. Obviously, if you live in New York or San Francisco or LA, houses are very expensive, but outside those big major cities or global cities, it's actually much cheaper to buy a home than it is to rent, which is in stark contrast to Australia. So a lot of people are worried at the moment that with interest rates going up, people aren't going to borrow money and buy new homes. But history usually actually has it the other way, and that is that people actually act ahead of interest rates going up to lock in those nice low interest rates. And with employment still coming down in America, interest costs are very low, there's just actually a lot of reasons, with that millennial cohort coming through, of why we expect more homes to be built in the future, and we think NVR is very well placed. The final slide there is how can you beat the market. I won't go through all the points. This is the same slide we had up in November. This is really just a framework of how we're approaching what is overall an expensive market, and we just need to make sure that we're just looking at individual businesses like Fox, which is a great example, where we actually sat down, went through all the divisions, calculated the value of each, and realised that you're actually getting potentially a gem in Star India for free. But if you're just looking at the market, then you're never going to uncover those sorts of opportunities. So that's where we focus our time. So with that, we'll move on to questions. So the first question is, this sounds like a perfect question for Wayne. It's a while since we've seen any sort of correction or even a wobble in the latest surge of the bull markets. Do you feel comfortable at present about markets, or do you think the probability of some sort of correction coming soon is now elevated?
Well, Nathan, the valuations of the key indices are all at all-time highs, and clearly we believe they're fully valued, if not overvalued. So some form of correction would not surprise us in the near to medium term. But as has been the case for the last 5 to 7 years, you have to look under the hood to see what's actually driven the indices to these highs. And there are clear sectors of the market that have been fully valued, in some cases overvalued in our view, but some sectors have been decimated, and it's been those areas where we've found the opportunities. So as far as our portfolio is concerned, we're as excited about our portfolio and the value that's offered within that portfolio and the names than we have ever been. So looking forward, we believe where we've had a market that has been driven by momentum and growth over the last 7 to 8 years is clearly set to move to allow value to shine through moving forward. And we believe the growth momentum strategies that's worked well over the last 7 to 8 years will now underperform value significantly moving forward. A good example, and I can highlight this with every company in our portfolio, if you look at just the last 12 months and the share price movements, there have been very significant movements. Bank of America is a good one, which we've only recently exited on valuation grounds. January 1 last year, it was trading at $17 a share. 6 weeks later, in the middle of February, it was $11.20 and change. And then it finished the year at $22. Now, this is not a small, obscured company that no one follows. It's a major cap. It has as many analysts following it as any other company in the world, and yet you have those type of price movements. Absolutely staggering. But you've had that with a lot of businesses, and this is where a portfolio and investment team that are focused on finding businesses that have prices significantly less than their long-term intrinsic value can come into their own. And so we're very excited about the portfolio that we have in front of us at the moment.
I think one of the mistakes a lot of people have made is that they've been waiting for GFC Mark II, and they've been waiting for that for a long time, and yet the market just continues to go up. And I think what we try to explain to people is that we're just stock by stock. And with Fox, for example, where we found Star India was potentially not paying much for, if anything, if you're just sitting there looking for the big market falls all the time, then you're probably never going to get invested. And I think the GFC has been seared into people's mind, which is not to say that we're not going to have more big downturns in the markets over time, but next time it might be completely different. This time around, all the banks, at least outside Europe anyway, have been fixed up. Their capital levels are higher than ever. The housing market doesn't present the global risk. The US housing market doesn't present the global risk because of the securitisation that it did when we had CDO squareds during the GFC. So in this case, it might actually be a case where we don't actually get a financial cataclysm that drives the next bear market. It might just be more like a 99, 2000 period where the most expensive stocks just see their PEs deflate slowly over time, and we see the value names come back because there is still a lot of dispersion in the market, despite what you're seeing at an overall index level. So the second question is, how is your investment portfolio in the United States likely to be impacted by the Trump policies?
Well, we do not let prospective or recent political events impact us on our stock selection. We won't buy a position unless we're prepared to own it for 10 years, and our average holding period is north of 7 years. So those timeframes tend to see numerous political cycles occur, and we've never allowed, a general market view or our own personal views of who will likely win the upcoming elections, whether they be in Europe, Asia or North America, to impact our stock selection. We're simply looking for businesses that have that competitive strength and run by management that are just are looking and are skilled to grow that competitive strength, and have also the shareholder focus to allocate the free cash flow once they've made that money in the most value accretive way to shareholders. And this last year has been a classic where Trump has won the election, much to dismay of many of the market, but where the market expected the market to react very negatively, it's actually boomed since Trump's been elected. So we just don't spend any time, Nathan, thinking in those type of terms. The coming European political environment over the forthcoming year is also fraught with a lot of unknowns. You've got the French election on April 23rd, and then you've got the German elections, the date for which hasn't been set, but it'll run somewhere between August and October of this year. Very uncertain outcomes. We have investments in continental Europe through our Liberty Global exposure, and the tailwind for that business and that industry are just so significant that irrespective of what the political outcomes, those businesses will do just fine. So
a question on Twitter, the recent results saw the share price drop. Did we increase our stake in the business?
Yeah, we certainly did. And as I highlighted previously when I talked about Twitter, the fundamental numbers that we look to are trending very, very positively upwards. The quick down movement allowed us to top our position up, and as you probably noticed, the price has already started to recover. It was up another 4 or 5% last night. It just goes to show the volatility is a friend of the value investor. We have our intrinsic value at a significantly higher price than where it is today, and if the stock were to fall significantly from here without any news that allowed us to revise our intrinsic value, then we would also add to it.
A question from Dan. You've previously talked about moving the portfolio to a more fully invested level. Cash is sitting at a bit under 30%, so this doesn't seem to be happening yet. Are you finding it hard to find well-valued companies to invest in?
Well, our goal is to be as close to fully invested as possible, and as you may know, Dan, cash is not a component of the portfolio that we target. It's simply a byproduct of us finding opportunities or not. So yes, the environment has been certainly more challenging now than it was, say, 7 or 8 years ago, but that cash can move around very quickly. And as you would have observed last year, that cash got down to around 10% partway through the year by us just acquiring 3 or 4 new positions. We have half a dozen companies that we're currently working on at the moment that are very prospective, so you could easily review the portfolio in a month's time and see that cash down very significantly from here. We simply use cash. It's simply a byproduct of us finding those opportunities. But don't forget, cash has enormous optionality, and the opportunity set as a long-term investor is not necessarily the opportunity set that's on offer today. I mean, we have to, we're mindful that we have a lot of businesses we'd love to own, but they may offer much better value in 6 or 12 months. So we're very disciplined to buying only when we can get our margin of safety, and otherwise we just monitor those businesses on our watch list.
Yeah, I think the other thing, the other reason why the cash has stayed so high too is just timing. We've actually got more stocks in the portfolio right this minute than we've had for quite a while. But the couple of the big sales from last year were Michael Hill, which worked out very well for us over a very long period, and Bank of America. Also, they were large positions for us and they went out, but the stocks that we've replaced them with have just been in much smaller position sizes because we're just getting started, whereas those businesses have been in the portfolio for a long time and had grown to much larger position sizes. But definitely over the next, over the full cycle, we expect to be more fully invested.
On that note, last year we saw a lot of activity in the portfolio. 13 new names came into the portfolio, but of course, as Nathan just highlighted, we were priced out of a number of those positions. Precision Cast Parts was a major holding for us, and that was acquired by Berkshire Hathaway. So if they hadn't come along, our cash position would be significantly lower than it is today.
Maybe there's some writing on the wall with Buffett buying into Sirius XM overnight.
Well, as you all know, Sirius has been a long holding of ours now, and it was just disclosed last night that that Berkshire have been buying into Sirius in the recent quarter. So we're hoping that doesn't get taken out. As a long-term investor, we've totally focused on the free cash flow that will come back to us over a 10+ year time horizon, and to be taken out in the short term at a, say, 20 or 30% premium, yes, that's nice for the short-term returns, but it mitigates the long-term returns, which will be much more significant if we were able to own that position for 10 years. So we do not like getting taken out of positions in our portfolio.
Here's a question for you, Wayne, from William. How do you manage key person risk in your business?
Well, the team is now 5 analysts, most of which have been with us for very long periods of time, 10+ years. The key man risk issue is raised occasionally. I believe in much larger organisations it's a much bigger issue. There is no way I'm going off to work for another firm, and all the other equity holders in the business. The problem with a large organisation is there's much bigger incentives to move elsewhere. Of course, there's always the proverbial bust situation where something occurs and we're no longer in health to run the business. But there is really no risk from the investor's perspective. The portfolio that we've constructed is very long-term in its nature. Our historical performance can ascribe to that. We've been operating for 16+ years now, and if something were to happen with myself, Nathan, and or Michael, then every investor can reassess the remaining team and their credibility and make a decision in a considered manner and not have to rush to exit immediately. We have succession planning in place, and the talent that we're developing within the team continues to grow day by day. I have full confidence that if I were to round tomorrow, that the team would continue to exercise on our disciplined approach, and investors can then make a call whether they remain with us or not. The way we construct our portfolio, one of our acid tests is if the markets were closed for 10 years, would we be happy with the portfolio that we have to hand at the moment? And the question is unequivocally yes.
I can also say that Wayne takes very good care of himself. Okay, so I might just one more question. What are your thoughts on the Australian dollar?
At the moment, the only forward hedge we have in our portfolio, and as you would all be aware, the starting position is unhedged, is the currency of the renminbi. We have two positions in the portfolio in the names of JD.com and Baidu, which represent just on 6% of the portfolio. And because the Chinese currency, the renminbi, is pegged to the US dollar, and there's significant downward pressure on that currency, we have hedged that currency back to the US dollar. There are no other hedges in place, so the look-through revenue streams of our portfolio, which are articulated on a monthly basis in our monthly update report, is where the currency exposures lie. The only other aspect is the cash that we're holding, which is significant, as Dan pointed out. We have made a decision to hold that in US dollars. So the US dollar position in our cash has cost us money over the last 12 months as the Australian dollar has strengthened somewhat. Our view on the Australian dollar, though, hasn't changed. We believe that the pressure will continue to be to the downside, and that is the reason that we continue to hold our cash in USD.
I also think investors come to us for some overseas diversification, so you certainly don't want to be putting the hedges on too early. The currencies can swing all over the place in the short term. But the numbers that I've heard are that SMSFs, for example, have only 1 to 2% of their assets invested abroad. Now, when you've got Australia potentially sitting on a huge housing bubble, and most people owning their own home, having investment properties, having big stakes in the banks in not just their own portfolios but their superannuation portfolios, it really is a one-way bet on the housing market in Australia. So I think what we offer to people is diversification, not just in terms of the type of stocks and industries that we invest in, but also some currency exposure as well. So I think, obviously, if we think the dollar gets low enough and it's going to cause a lot of pain if it went up, then we'd look to put the hedges on. But we're currently roughly at the long-term average, the US v the Aussie dollar, so we're not in a rush to put any hedges on. Might just squeeze one more question in from William. Any thoughts on Buffett buying into the airlines?
Well, it's very interesting. He's obviously changed his view on that. We've certainly looked at the airlines. More recently, there's a couple that we do like, but we certainly haven't pulled the trigger on. Ryanair is a very interesting example if you're looking into that industry. Clearly, the industry has consolidated in North America. That will improve the economics, but this is a business we'd be very happy just to watch from the sidelines. Berkshire have obviously changed their mind.
I saw a headline too, I didn't read the article, but Trump's sort of war on regulation somehow seemed to be of benefits to the airlines, but I don't know the industry well enough to know what regulations can be removed to free up the airlines, but also maintain the sort of absence of competitive behaviour that's been so dismal for the industry in the past.
William, I might just add that what's really important to develop a long-term attractive performance in your investment strategy is to ensure that you don't try and tackle too difficult issues with your investment. I mean, the old adage that we're really looking for investment decisions that are a 1-foot hurdle as opposed to a 7-foot hurdle. It's something that we live with day in, day out. And just because someone else is doing something, unless we feel like we have an edge and that area is squarely within our circle of competence, we just pass it by. I mean, there's no call strikes in investing, and the market is a very large place, so we go to where we can find the 1-foot hurdles, and we're very mindful that we don't tackle opportunities that are just very, very difficult and complex.
Wise words. Thank you very much, Wayne. Thank you everyone for listening in today. By all means, if you have any further questions, please don't hesitate to get in touch. You can either give Alex, our Head of Distribution, a call, or give myself a call, and we'll be only too happy to help. Thanks again.